In 2018, a company was losing an estimated $40 on every single customer. Every month. By design, they had 3 million of those customers. The board considered this a success. MoviePass launched in 2011. The premise was straightforward: pay a monthly subscription fee, see movies in theaters. Think Netflix but for cinema. Clean idea, real market, legitimate problem to solve. Americans love going to the movies. Or they say they do. In reality, the average American visited a movie theater roughly 5 times a year by the mid-2010s. Ticket prices had been climbing for a decade. Audiences were grumbling. MoviePass smelled opportunity. The original model was cautious. Subscriptions were priced between $30 and $50 a month depending on the market. Not thrilling, not viral, but not mathematically insane. The company stayed small, struggled, limped along. By 2017, MoviePass had fewer than 20,000 subscribers. 6 years in, and the company was essentially a rounding error. Then a data analytics firm called Helios and Matheson Analytics acquired a majority stake. And that is where things get interesting. Helios and Matheson's CEO, Ted Farnsworth, had a vision. Not for movies exactly, for data. The theory was that MoviePass subscribers would generate enormously valuable behavioral data. What films people saw, when, where, and that data could be sold to Hollywood studios and advertisers. The movies were almost beside the point. It was, in a certain light, a clever idea. In another, more accurate light, it required first acquiring millions of subscribers before a single dollar of data revenue materialized. You had to bleed enormously before you could profit. The executives understood this. They proceeded anyway. In August 2017, MoviePass made the move that changed everything. They dropped their subscription price to $9.95 a month for unlimited movies. The average American movie ticket at the time cost over $9. This meant MoviePass was essentially offering to pay customers to go to the movies. The internet noticed immediately. The story went viral within hours. Tech journalists called it disruptive. Twitter called it insane. AMC Theaters, the largest cinema chain in the United States, called it, and this is a direct quote from their CEO, not in the best interest of MoviePass's long-term financial health. AMC was correct. MoviePass sued them anyway. Subscribers flooded in. Within 3 months, MoviePass went from under 20,000 subscribers to over 1 million. By the following summer, they were approaching 3 million. It was, by every vanity metric, a sensation. The press loved it. Investors were buzzing. Mitch Lowe, the company's CEO, went on television to celebrate. Lowe had real credentials for what it's worth. He had been a founding executive at Netflix and a president at Redbox. He was not a naive man. He was, however, apparently a very optimistic one. The math was not complicated. If a subscriber saw even 2 movies a month, MoviePass lost money on that customer. The average MoviePass user was seeing, reportedly, 2 to 3 films per month. The company was structured to lose money at scale, and they were scaling as fast as they possibly could. Here is how MoviePass actually worked operationally. When a subscriber bought a ticket, MoviePass loaded the purchase price onto a prepaid debit card in real time. The company then paid the theater the full retail price for that ticket. There was no discount, no negotiated rate. MoviePass paid full price so that you didn't have to, every single time. The theaters, understandably, were perfectly happy with this arrangement. They were getting full ticket revenue from someone else's money. Theater chains had zero incentive to negotiate, partner, or help MoviePass survive. They just kept cashing checks. MoviePass attempted to build studio partnerships. They tried to negotiate revenue-sharing deals where studios would pay MoviePass a cut of box office revenue driven by subscribers. Studios declined. Why would they pay for audience behavior they were already receiving for free? By late 2017, Helios and Matheson's stock had spiked dramatically on the MoviePass buzz. The company used this window to raise capital through stock offerings. They raised hundreds of millions of dollars. Most of it went directly to covering operating losses. It was, effectively, a bucket brigade trying to fill a bathtub with no bottom. In 2018, the situation became critical. MoviePass was burning through cash at a rate that alarmed even its most optimistic backers. The company began making increasingly desperate moves. They quietly removed popular films from the app. They introduced surge pricing. They limited subscribers to 3 movies per month, directly contradicting their advertised unlimited model. The customer backlash was swift and merciless. Users who had signed annual contracts found the product they'd paid for no longer existed. Class action lawsuits followed. The press, which had celebrated MoviePass 2 years earlier, now covered it with the particular relish journalists reserve for spectacular, avoidable failures. In July 2018, MoviePass ran out of money to pay for customer tickets. Completely. The service went dark for nearly 24 hours while the company executed an emergency $10 million loan just to keep operating for a few more weeks. This was not a private crisis. It was publicly documented in SEC filings. The company announced it in a press release. They were borrowing $10 million on an emergency basis to survive the weekend. Helios and Matheson stock, which had briefly traded at over $30 a share in late 2017, fell below 1 cent in 2018. The company underwent a 1-for-250 reverse stock split to stay listed on NASDAQ. Then the stock fell below 1 cent again. This happened twice. MoviePass officially suspended its service in September 2019. At its peak, the company had spent an estimated $400 million. It had never turned a profit. Not once, not for a single quarter. The data business, the grand theory that justified all of it, generated revenues that were, according to reports, negligible. In 2021, the Federal Trade Commission charged Helios and Matheson, Mitch Lowe, and Ted Farnsworth with fraud, alleging they had deceived subscribers with repeated changes to the service and misrepresented the company's financial condition. Lowe and Farnsworth settled without admitting wrongdoing. The company, of course, no longer existed to pay much of anything. There is a version of this story where MoviePass was a visionary idea that failed due to execution. That version is wrong. The pricing model required either immediate massive partnerships with studios and theaters, which the industry refused to provide, or a subscriber base so enormous that data revenue could sustain losses. Neither was remotely guaranteed. Both were treated as inevitable. The deeper lesson is one that corporate history keeps teaching and executives keep ignoring. Growth is not a business model. MoviePass confused acquiring customers with building value. 3 million subscribers meant nothing if every one of those subscribers cost more to serve than they paid. Scale, in this case, did not create efficiency. It created a faster drain. The subscription economy rewards companies that can reduce the cost of delivering value as they grow. Software, streaming, cloud services. These models get cheaper per user at scale. MoviePass paid retail price for a physical good every single time a user engaged. Engagement was the enemy. Their best customer was their worst nightmare. MoviePass did not fail because the market rejected it. The market loved it. It failed because loving a product and it being a viable business are two entirely different things. Someone should have checked. If you want to know what happens when a company does check, when a subscription model actually works, the story of how Netflix survived its own near-death moment is next. Subscribe for more hidden empires.